Hello everyone, it's me the Boss Hog, and a slightly different video today. As we near the end of the first quarter this year, I wanted to review one of my primary targets, which is building wealth, how we're doing, what my outlook is for this year, and generally how I'm coping with a falling stock market, which is definitely detrimental to building wealth. Let's do it. All right, so in terms of targets for this year, really I tweaked the way that I thought about building wealth because I realized that there's only so much that I can influence in terms of how the market is behaving. Obviously, to a degree, I pick stocks, I pick ETFs, etc., etc. But in the short term, especially, let's say less than 5 years, there's very little I can do to actually influence the market in any meaningful way. So, short of picking good tickers and all the rest of it, there isn't a ton of stuff I can do. And I think it can be detrimental. Certainly, I felt it when you're like looking at the market every day and like viewing that as your wealth going up and down. I know sort of Buffett and things talk about, the value of your house. It doesn't matter unless you come to sell it, right? And similar in terms of wealth building, especially when you're in the accretive stage and still trying to make progress. So what I wanted to do for 2023 is basically have specifically targets that I control fully. And by I mean me and my wife. We're definitely a team, and she contributes very materially to our overall income and indeed wealth. So when I say I, it's collective we really. So the target for 2023, which I shared 3 months ago, is to add to our investments a total of 70,000. So basically that's new capital that we are adding to our investments. Not all of that money is ours. Some of it's government help, as like we add, the government gives us rebates and stuff like that, as we can touch on in a second. But ultimately, we influence this figure fully. So that to me is the important difference compared to what I've done in previous years. The overall target is to retire at 55, specifically when I'm 55, so May 2042. With 5 million in wealth. I appreciate, again, that's a lot of money. Me and my wife do have relatively expensive tastes. We live in London and we're both at kind of the peak or near peak of our earnings and indeed costs currently as well. Man, you should see the cost of my nursery at the moment for my daughter. But this is the direction of travel. So we still have 20 years to get to this point. And yeah, this is the long-term goal, basically, to retire with 5 million. Broadly speaking, that is split. A majority of that is split quite evenly between private pensions and ISAs. And of course, for anyone who's familiar with UK law, we won't be able to access our private pensions until we're 58. So in the early days, we'll be leaning very heavily on our ISAs specifically. And then there's also a little bit extra for things like the value of our home, the expected renting, etc. as well. Should be about 20 grand a year, even at today's prices. So I would expect that to increase in the future as well. So that's the long-term goal effectively. Just as a sort of rule, any figures I've used in this video are based on the 21st of March. There are two exceptional items that March doesn't currently include that would actually increase our wealth, which is my employer / current pension providing website, Scottish Widows, seem to be very slow. So it takes them about 4 weeks to add last month's pension into my pension pot. Typically it arrives about the 25th or 26th of each month, so obviously I haven't yet got that. And also as well, although I get paid on the 20th, my wife gets paid on the last Friday, I think it is, of the month, so she hasn't yet been paid. And again, she roughly speaking, our earning is about 60-40, me 60%, but again, it works out slightly differently after tax because tax is quite progressive in the UK. So that's basically the targets, both in terms of the short term and long terms. And now I just want to walk through very quickly, actually, how we're doing in terms of those targets. All right, so broadly, I would say we're running about on schedule, if anything, actually slightly ahead. To be honest, I'm expecting our cost to reduce quite substantially in September. My daughter is changing nursery and going to school, and because of the strange situation with UK nurseries, that's actually more expensive than her fee-paying school. So that's a strange situation to be actually sending our daughter to private education and saving money compared to what we're spending on a nursery, which does kind of highlight just how expensive UK nurseries are. I do expect our cost to increase during the summer. We have sort of a couple of my wife's friends are getting married. We've got some trips. We want to go on holiday before our daughter starts the school cycle, when everything becomes more expensive in terms of going, outside of term time, etc. But then, like I say, in Q4, so from September, I would expect our cost to reduce quite substantially by sort of about £700 to £800 a month. So that would also be quite a big boost. You can see here I've broken this down into various areas. And I guess the first thing to highlight is probably the February movement there. If you look at non-ISA investments, I moved just over 8,000 from non-ISA investments to my ISA. There's a couple of reasons for this. First of all, it was primarily tax. A lot of my non-ISA investments were sitting in a company called Games Workshop. They have become quite the dividend payer, and a combination of that and changes to UK dividend tax just meant that I needed to get this money out of my general investment account where it's taxable above a certain amount, which it was going to qualify for, into my ISA where it isn't taxable in terms of the dividend or indeed capital gains. So that was a bit of a movement. Now, in fairness, I had been using my non-ISA investments as a bit of a cash reserve. So it was previously about 15,000, which is, about 4 months worth of cost for us, which felt sufficient for an emergency fund. And as a result of that, I'm very aware that we are running our emergency fund too close to the wire. So one of my plans this year is to basically add back into non-ISA investments, primarily in premium bonds, just because, a lot more stable, and the interest on those has also grown quite substantially over 2022. So I want to really grow premium bonds to, mid to high 4 figures over this year, and then take it from there and treat that as my emergency fund. So that's the plan in there. And just more of the same, really. In terms of the colors, so I think it's reasonably self-explanatory. You can kind of tell, with the only maybe bit that isn't clear is my pension contribution. And again, I know these figures because they show up in my pay slip, and I've already been paid for April, so I know these figures will be added, but so far they haven't yet made it. So as a result of that, they're not showing up in my wealth currently. March is about 1.6k, 1.65. So quite a substantial amount. Now, you might notice, if you're really keen on numbers, that April goes down very slightly in terms of my pension contribution. That's just because I had a day sick. So I didn't work today. My employer is quite strict on that policy, and obviously I don't qualify for statutory pay as a result. I'm normally quite well, but I was quite ill, so it is what it is. But as a result of that, I'm paying less, and also then the tax rebate I get from the government is reduced as well. However, because I'm already paying more than my maximum employer match, actually my employer amount would still be 733, which is great. My wife does pay less into her pensions than I do at the moment. We are looking to revisit that potentially when my wife has her next change in jobs, which, she's been very busy at work. She's basically doing the work of a director at the moment, but the salary of a head of. So I do expect that to change in the next sort of 6 to 9 months as the next time she has a review. But right now, I think it's comfortable the way that we're treating it from that perspective. So you can see here, like basically within each of our private tax contributions, our 3 components are the government rebate that you get, and then the employer contribution as well. So worth calling out. You can see here the ISAs are basically planning for 3,300 a month. That basically assumes that we max out our ISAs over any one tax year. To be honest, it won't actually look like this. Like every quarter, we have certain quarterly bills around the management of our flat and various other things as well. But this is kind of smoothed out over the year with, like I say, the hope that we will be getting to 70,000. My daughter also has an ISA. We could actually put more than £100 into it, but we think that that's sufficient to give an 18-year-old, about 45 grand when she gets access to it. So for now, we're treating it as familial wealth. Obviously, when my wife and I retire, it won't be our money, although it will be a very small part of our wealth as a percentage by that time. But for now, I think it's okay to include it, and so I do. And then the non-ISA investments here, this is, like I say, going to be led by premium bonds. But it was nice that I was able to add both 225 into premium bonds this month, as well as 250 into my general investment account. So that was a nice, actually. I'm quite pleased with that because I thought March would be a little bit tighter than it actually ended up. So I think that's good. So this is the plan for the rest of the year. Again, I will be populating this with actuals as we go. I think the biggest change is going to be in the ISA contributions, just because I might add more or less depending on other cost commitments, as well as the non-ISA as well. Again, that's basically, you can think of that as our emergency fund, but again, I don't just want cash in the bank. To me, if I have more than 1,000 in the bank, it's basically wasteful, over any period of time. So that's really the approach that we're going to be taking. So that's some details, but I just want to go into a bit more now in terms of how we're doing for the long run. All right, so The previous overview was how we're adding this, how we're going to hit the 70k. Now we're moving on to our existing wealth, and you can see here across the last 3 months it's basically stagnated. But if you look within detail, you kind of understand why, and it's really just been impacted by the direction of travel within the market. So this line here, the like my pension in Nutmeg, this is my consolidated pensions from previous employers. So I'm not adding new capital to it basically, and as a result, it's completely at the whims of the market, right? So that is what it is. This one here, my current pension with Scottish Widows, this is the one that I'm actively adding money to, and you can kind of see it adding here. This January and February is very close just because it took me a little while to get access to the portal, so I'd already basically counted that month. And then from March and now it should basically be increasing about 1.6k in terms of new capital, but again, it still is influenced of course by the market. Then my wife has a legacy pension here with People's Pension, which I found extremely difficult to deal with. I think they're a bit of a Mickey Mouse organization, to be honest, but I am looking to consolidate this as well. Then her consolidated pension with Nutmeg, again, this is quite small. My wife has a doctorate, was quite late into the career, but actually she has an incredibly steep career history. So I kind of expect in the next sort of 5 years that my wife will overtake me in terms of earnings, which I'm totally fine with, by the way. And then her current pension is with Legal and General, so big up to everyone, because I know there's a ton of Legal and General dividend holders, stockholders in my subscribers, so that's awesome as well. And actually I quite like their website, so I've made some tweaks here. Again, I was kind of estimating what her pension was before I got access to it, and was pleasantly surprised that it is as high as it was. That was somewhat surprising to me. So you can see here this jump is somewhat artificial, but it's just like a reflection of reality. So this 4882 is now accurate basically. This one might be slightly controversial because I know some people won't include home equity because it's not being realized at the moment, but I feel very comfortable including it. Ultimately this is the estimated value of my home, and I did recently remortgage, so I got a pretty good update. And then what I'm doing is I'm looking at the flat increasing in price in my borough, and basically extrapolating. So that was 2.5% last year. So I'm basically doing that as the growth. And so the home equity is growing as a combination of the house going up in value, as well as me paying off the capital as part of my mortgage repayments, right? So that's what that is basically. And again, I think it's completely defensible. I mean, I live in a fairly central zone 2 London flat. And yeah, even though it's just a 2-bed, it's the better part of $500,000, which again just kind of shows you how crazy certain things about the UK is, in this case London house prices. Next up, we got our cash in Santander. So I said I didn't really like to keep more than 1,000 in cash, but this includes my income, but it doesn't yet include a lot of the costs, right, that we're going to have in early April, things like mortgage, things like nursery, etc., etc. And we've also got service charges for our flat and things like that in April as well, quarterly. So yeah, again, this figure at the moment is basically already accounted for from that perspective. My wife will add in a week's, and then we'll basically run that down, and obviously we'll start adding to investments over April from those payrolls, so that makes sense. My daughter's ISA is also in Nutmeg. By the way, if anyone wants a link to Nutmeg, I do recommend it. It's a very low maintenance management of stuff, which for me, because I'm quite actively managing current pensions as well as ISA, really works for me, and I get a very simple dashboard as well. So I'm happy to recommend Nutmeg. Last year they were bought by JP Morgan, so they got very large backing now, and I like what they're doing basically. So I think if we recommend each other, we get some cash basically. So if anyone's interested, just let me know. I'll set up a link. Then we've got my ISAs. So these are linked to lifetime into my portfolio dashboard that we cover weekly in our videos basically. Obviously this has been a bit rough at the moment, which is a shame, but again, it is what it is, right? If you were to look at this 8 weeks ago, it's a very different story in terms of how they looked. Then our non-ISA investments. So again, you can see here the big drop between January closing and Feb closing. That was because we moved out of the Games Workshop position, right, for the 8,000, as well as market movements were not favorable. And then we got premium bonds. So again, this is quite new. Now, if you're really noticing, you might notice that I mentioned about 225 on the previous overview and 250 here. I have actually had premium bonds for about 4 years, or I guess from 2021, so 2 years. But I just had like £25 in there, which is the minimum to open it up, right? I kind of just forgot about it. I've never included it. But now this is my actual balance on NS&I, so National Savings and Investments. And again, we will now keep this accurate moving forward. And then this last one, again, might be somewhat controversial, but to me it's an asset, so I think it should be counted. Basically, I have deposits with a couple of people, and I will get them back in due course. One of them here for LCA is the name, the abbreviation of my daughter's nursery, which I think I'd rather not share for obvious reasons. But they have like a £400 deposit, so when she leaves the nursery and goes to school, then we will get the £400 back, right, from the deposit, etc., etc. So again, that's going to basically convert to cash in 6 months' time. So for me, I think again it's completely defensible, and yeah, no issues from me. The only thing is like I say, it's stagnated, and as you'll see in a second in terms of the road to 5 million, that creates some challenges in terms of the bigger objectives that we're working toward. But anyway, let's have a look at that now to round everything off. All right, so and then this is my overall aim. So I guess we'll start on the two top graphs or tables just to explain. So what I've done is when I was first mapping out my road to 5 million, right, I basically created a pivot table where if you select on the year, it'll tell you what your wealth's going to be. And so what I did is I lined up that pivot table with the closest full month I could find for various steps, right? So ultimately December 41, so actually 5 months before I'm due to retire, we should be hitting 5 million, right? That's if everything goes right. And there are, of course, many assumptions built into that. The biggest one is the fact that I'm projecting an 8% compounded return on stock market investments. So obviously where the market has underperformed in 2022 and to 2023 to date, that's not factoring through in any way, and is actually kind of because we're running behind that curve. I sort of expect at this point to miss January 24 for having 500,000. Like, even if you accept that we've still got 53k to add this year, we could make that maybe 58, 59, because it technically is until the end of January next year, but that's only going to take us to about 410, something like that, even pushing it quite a lot. So that unless the stock market massively rebounds the rest of the year, then I expect to miss that target. And I think for me, like, it's important to be honest, and like, again, as long as we're hitting our targets, maxing out our ISAs every year is critically important. And then so that's 40,000, right? And then there's 30,000 on other things. So as long as we hit those objectives, what happens with the housing market, that has an impact. But the bigger impact is certainly what happens with the stock market. That impacts both our ISAs and our pensions, which are of course linked to the stock market. So from my perspective, it's discouraging, but actually the more I understand stock market performance, the more I understand that 8% is a very crude average, and that, you're just as likely to see a market that's plus 50% as minus 20%, as 8 to 10%, right? When you actually look at the performance over a long period of time, it's all over the place. So I'm trying not to overthink it too much. For me, I'm keeping it with things that I can control, which is basically adding money into our wealth, so that in the long term and over the law of averages, we should be in a position where in 20 years we'll hit this 5 million. Obviously, if the stock market goes well over that time, we're going to be in a great position. And frankly, I'd rather that the market was underperforming now whilst I'm in the kind of accretive stage, right? That's how I'd rather have it, rather than basically overpaying for stuff at the moment. I'd rather overpay right at the very end, when again, hopefully by then we'll have all of our wealth in the market, and we'll be doing really well. So that's I think, again, I'm not going to change these targets now. I think I based them on reasonable assumptions about growth in terms of the markets, the housing market, etc. So I'm going to stand by them, and we're just going to review as and when and how badly we miss it. And over time, I would expect it to normalize as a result of those averages. The top right graph, I mean, these are meant to kind of be in order, right? So going from easy to hard. But when I first started, I had like a 5% dividend yield. And so I sort of expected to hit that number at a similar time to, I mean, actually slightly before we got things like 100 grand in shares. But over the time, I've basically reduced my dividend yield by targeting higher growth and being less focused on dividend yield, which I think is okay in the long run. Because again, I don't need the income at the moment. It's all about building overall wealth. And of course, dividend income is part of that, but it's not the primary reason. So I expect to hit the 3K this year, basically. In terms of a rolling 12 months, I should actually hit it in about 6 months once all of the UK final dividends start to pay. That should give me a rolling 12 months 3K. But this is actually based on calendar year, I decided. So again, we'll review this in a year's time, and hopefully this will be passed. And indeed, the 5K, right, we'll be making major progress toward that as well, though I don't think it will be passed. So you'll see here that the dividend targets haven't progressed as much as the overall wealth targets as a result of that. Similar thing happens here, like I'm 69% of the way to £500,000, but only 55% of the way to 5k in dividends. So again, that's an impact as well. Roughly speaking, again, you can take the net wealth and put half of it in stocks and shares ISA. So here, my original assumption was that at about the same time as I had 250 grand in my shares, I would be receiving 5k a year in dividends, right? And that's just not the case. I'm going to have more than 250k in shares to get 5k in dividends. I think at the moment it's like 3.2% is my average yield in my portfolio. So again, I think it's okay. It's just a change in investment focus I made when I got more familiar with understanding the stock market, etc. And then we start to get into really big numbers. So 10k a year in dividends for me is going to be massive. And then, you know, having £1 million, it just seems quite surreal at the moment. But obviously, I very much expect to get there in this decade. So that will be amazing when that happens. And the eventual goal is to get to 5 million. And at that stage, what I think would happen is like basically the very final goal here will turn green, because I will engineer our investments so that they yield at least 100,000 a year in dividends, right? That's basically going to be what happens. As I touched on, for the first 3 years of retirement, we won't have access to our private pension. So I will have a very, my approach will basically be to do something like spend about 6% per year from my ISA. Obviously, that's unsustainable, but again, the private pension kicks in shortly afterwards. And realistically, we're looking to have about 150 to 200,000 a year spend in our retirement. That's basically the plan. So about £500 a day, which should mean that you can holiday forever in some beautiful places, which is where we want to be getting to, as well as some nice food and drink. So that's the plan basically. So I think the road to 5 million is still there. We're definitely behind schedule. The way of dealing with that is really just to focus on the things that we can control. So adding 70k plus a year. Again, anything over that would just be a fantastic win for me. And my wife has already asked if we hit anything over that, whether we can start to overpay our mortgage. So that would be what would happen at 70k, which I think is a fine concession. I don't think it's the most efficient thing we could be doing, but again, it matters to her. So important we think about wifey, right? And that's basically going to be the approach. Like if we can keep our own targets in place for the next 10 to 20 years, then by the time we get here, whatever's happened within the market, we have no real control over, as long as we're not picking, you know, dodgy stocks and all the rest of it. So we'll do our best there. But broadly speaking, we're just focusing on that, and everything else is kind of noise. So, and actually, once I got past that stage, there were definitely times in 2022 where I kind of struggled, like, you know, but now I've got to the point where actually I do genuinely feel quite zen about it. I think we're making good progress this year. And even though we are running behind our targets to our road to 5 million, I think it's easily explainable and should normalize over the next few years. Again, by next few, I mean the next decade or two. So that's all I'm thinking about basically. And now I'm no longer, you know, worried about it. Anyway, any questions, comments, etc., let me know. Hopefully this is interesting for everybody. Otherwise, thanks very much for watching, everyone. I've been the Boss Hog, and good luck with your investing. Bye for now.